Good afternoon, everyone, and welcome to the Franklin Board of Mayor and Aldermen's Pension Committee meeting. We'll call the meeting to order. First item on the agenda, do a roll call vote, and I will ask just to recognize that by being present. Mayor Moore,
Present.
Chris Bull,
Present.
Kevin Townsend,
Present.
Keith McGee,
Present.
David McDaniel. And the chair is present also. Second item on the agenda is approval of minutes of March the 8th, 2021. I'll entertain a motion.
Motion to approve. Second.
Proper motion and a second. Kevin Townsend, how do you vote?
Yes.
Chris Bull, how do you vote?
Yes.
Mayor Moore, how do you vote?
Yes.
Keith McGee, how do you vote?
Yes.
David McDaniel?
Yes.
And the chair votes yes. Passes 6-0. Let's go to item 3, and I understand that Sarah Silvas will be virtual. It is a retirement of employee representative Jeff Rowe. Sylvia, are you? Is she?
She's on Zoom.
She's on.
Yes, I'm here.
Yes, I'm here. Look there.
I'm here. Can you see me or hear me okay? Okay, good. So Jeff Rowe was elected last year to our pension committee. He's our second employee representative along with Chris Bull. So he's chosen to do terminal leave right now, and he's retiring December 1st. So we started the process to fill his seat. We currently have 7 nominees. Actually, this year we've got a bunch of departments represented. So we have a parks nominee, water nominee, police nominee, engineering nominee, fire nominee, and 2 BNS employees that are nominated. So I find that very exciting that there's this much participation. So the nomination process ends on Monday the 30th. And then at that point, we will open voting. This year, due to COVID, we've decided to do in-person voting and voting through a standard pension committee email. We are going to also try to allow more participation in outlying departments. So we will have our normal ballot box at City Hall and the HR department, but we've also got a ballot box that we'll put at Public Works and one at Sanitation's administrative complex. So we'll see how that goes this year. Thank you.
Comments from staff on the nomination process or the election of a new employee representative? Any comments from the committee members? Any questions of Sarah? If not, let's go to item 4, which is investment report for 6/30/2021. Barry, I understand that you're also virtual, as I don't see you in the audience.
Can you hear me?
There you are, yes, we can hear you well.
All right, I can see people nodding, but and I see you're laughing. I haven't even started yet. Come on. All right, I'm going to assume that you can hear me, and I have to ask, are you going to broadcast the report? Do you want me to broadcast the report, or should I do it without the report? Oh, you've got the reports on your desk, correct? Okay, I see head nods. So I'm going to ask you to turn to page 4. I'm going to talk in 3 parts. I'm first going to talk about the second quarter. I'm then going to go back and talk about the first quarter. And I'm then going to talk about what is to come or what people think might be to come. So starting with the first quarter and starting with the economy, let's go to page 4. Sarah, are you the one that has control? Just nod, that would be good. No, she's going nodding, but the wrong way. Somebody else has control, but that's fine. We are on.
Barry, we've got it here.
Yeah,
Page
and I
4
can
is
hear
up.
you. I can now hear you. So all good. So GDP. Oh, and let me just ask, how are things down there in relationship to flooding? You tend to see Waverly's on the front page of the New York Times right now. There's a 40 dead, a 7-year-old girl missing. It's like pretty heartbreaking. How are things?
Rick, you gonna cover that?
We are doing fine. We've sent assistance over the weekend to both Hickman County and Humphreys County, and we were very fortunate. We had rain, but nothing near what just a little bit west of us was hit with.
Yeah, when I saw that, I'm worried. I'm hearing my own voice come back at me now in an echo. You guys have been badly flooded in the past, I know, and I'm glad that it missed you, but we feel for them. So fortunately on the investment front, I have pretty unqualified good news today. So starting with GDP, we have a 6.5% first estimate for GDP. The economy is now more or less back to where it was before COVID started, so back to the level it was at the end of 2019. There is controversy about a number of issues like employment and inflation and wages, but generally speaking, people are pretty positive about the direction of the economy. In terms of the market, the second quarter was another gangbusters quarter. Domestic stocks is represented by the Russell 3000, which is a very broad measure, much broader than the S&P 500 or the Dow, was up 8.2%. Foreign stocks represented by EFA, developed countries, and the emerging market index, those are the fifth and sixth indices down. Together, those were up 5.3%. Real estate was up 3.9%. Bonds, investment grade bonds, were up 1.8%. All of those numbers are above average. Bonds a little bit above average, stocks way above average. So this was a very good quarter. The typical portfolio was up 5.1%. Of note in this quarter, we had certain trends that dominated the market for most of the last decade. Those trends reversed themselves in the fourth quarter last year. Those trends were growth stocks did better than value stocks, large cap stocks did better than small cap stocks, domestic stocks did better than foreign stocks. Most of those trends reversed in the they all reversed in the fourth quarter, most reversed in the first quarter, but now in the second quarter, they all went back to the way they were before. So if you look at this box in the lower left-hand corner, if you see large cap growth stocks, that's the number. In the upper right-hand corner, that is the biggest number in the quarter, up 11.9%. Growth did better than value generally, large cap did better than small cap generally, and domestic did better than foreign. So we were kind of back to the way we were in the second quarter. So that is the economy and the market. Oh, no, that's all I'm going to say about that for right now. So let's now go to page 8. Stop right there. We returned 6.2%, ranked in the 12th percentile. This is an incredibly good number because, as I've said in the past, this isn't the most aggressive portfolio in the world. This is average, maybe a little bit below average, depending on the return environment. And yet, we had a really great return. Now, why do we have a really great return? Let's go now to page 17 and look at the disaggregation of the TCRS portfolio, the state portfolio where most of our money is in. Stop right there. Okay, so there's our 6.2, the same thing as our overall return. The reason we did so well is because TCRS has managed to outperform its indices in all pieces of the portfolio. They are managing these different allocations mostly on their own. International developed is an exception, but the North American equity, the international emerging market equity, private equity, real estate, strategic lending, domestic fixed income, all of those are being managed internally at TCRS. And all of those numbers were above their benchmarks. And particularly the domestic fixed income number, bonds don't vary very much, but doing 3.9 over 1.8 is a huge beat. And we have a lot of money in that, 23% of our overall portfolio. And so their shadow index, which is a measure of their indexes, was only 4.5, but they did so well beating those indexes that we had a 6.2% return that ranked in the 12th percentile. Now, the percentile rankings, that means we beat 88% of plans out there of all sizes. So this was a great quarter. But what I think is important to understand is what happened in the first quarter. And to do that, I don't think we've got that book handy, but I'm just going to read you the numbers in that regard that you kind of need to know. So on my computer, I've now got to go back to the first quarter. I think I went over these remarks in writing, but not orally. And I'm going back to the first quarter now because it is extremely important to understand this quarter in terms of understanding what you own. This quarter was the worst imaginable. I'm exaggerating, but only a little bit. I mean, I guess you could imagine a worse return environment for this portfolio, but it wouldn't be easy. And by that, I mean, this portfolio is a little bit fixed income heavy, but most importantly, it is a long duration portfolio. Now, what that means is our bonds, 23% of the overall portfolio in core bonds and some more in riskier stuff. Our bonds tend to be of longer duration. That means we have more 30-year bonds than 2-year bonds, just to pick one example. And when you have a long duration bond portfolio, you tend to move in extremes. If bonds go down, you go down more. If bonds go up, you go up more. And you tend to respond more negatively to interest rate changes. If interest rates go up, bonds go down, and you go down even more. The reason they are positioned that way is it is defensive. If the economy and the market goes to hell in the handbasket and stocks go down, bonds are likely to go up in that environment, and our bonds will go up more. So it is protective. But if you have a quarter where bonds go down, you're going to get killed. Now, if bonds go down, a lot of times the stock market's going to go up, as it did in the first quarter. So you have that to cushion it. But be that as it may, in the first quarter, we had the worst bond return in 40 years. You have to go all the way back to the early 1980s to find a bond return on a quarterly basis less than we had in the first quarter. The Bloomberg aggregate went down 3.4%. Now, did we go down more than that? Oh, yes, we did. We went down 6.4%, almost double. A terrible, terrible return. How did we do for the quarter? We still made 3.1% and ranked in the 48th percentile. We beat more than half the portfolios out there, even with that terrible bond number. And I can assure you, most other portfolios like that are not positioned that way. Other people did not suffer in that regard. Now, why did we do that? Because once again, in each one of these pieces, domestic equity, international equity, emerging market equity, private equity, real estate, strategic lending, they knocked the cover off the ball in every single one of them. And all of those beats enabled them to hold up the overall return in what should have been a terrible quarter for this particular asset allocation. And so if you combine the first and the second quarter, we have a 25th percentile return. And I can't remember what that return is, but anyway, it's good. We made 28% for the year, 10% for 3 years. I'm sorry, I'm reading from the first quarter numbers. Let me get the other numbers back in front. Actually, let me go back to the Zoom call now. So the message I want to impart to you today is I'm paid to be skeptical, and I'm looking at what's going wrong, and I'm trying to warn you about bad things that can happen. But I'm gradually becoming a real fan of this, of the people that are managing this money in Nashville for you. These last 2 quarters were really good. Now, they're just 2 quarters, and this is a business of probabilities. Maybe they got lucky, but I am very impressed by what I've seen so far in what is now, I think, I was always saying, they're doing well, but just wait till bonds go down, and we're going to see how badly this portfolio does. Well, they've now gone down, and the portfolio did just fine. So I'm really pretty positive on how things are going. I'm happy with the job they're doing for you. And I've looked at other state portfolios, and typically they just don't do this well. The ones that I've seen, or some of the ones I've seen. So I think you can be very pleased with this job. Are there any questions about our performance? And let me just read the overall numbers. 25% for 1 year, 12% for 3 years, 11% for 5 years, 5-year percentile, 39th percentile. And I might add 39th percentile means, 38% of the people did better. But you have downside protection. A lot of those people don't have, meaning if the market goes down, you're not going to go down as much. They are a less volatile portfolio than most of those people with really good returns over the last 5 years. So having said that, are there any questions about that? And if there are none, I'm going to go on to the future. But first, let me stop at that point. Questions?
Any questions from any committee member? Any questions from staff? Barry, I would go on.
All right. So market, I'm sorry, is somebody about to talk? Okay. Market going forward. The market is now trading about 20 times earnings. It was at 22. That ratio has come down a little bit because as earnings have rolled out in the second quarter, they have been really good. 80% of the companies, more than 80%, have beaten earnings estimates and sales estimates for the second quarter. To put that in perspective, the market average is about 15 times. So at 20 times, the market is expensive. But it was 29 times at the height of the tech bubble. So while it's expensive, it's not crazy expensive. We think the economy is going to continue to do well for the balance of the year. COVID is obviously a concern. Inflation is a concern, which I'm going to get to in a minute. And we do think that the kinds of returns we're getting right now are unsustainable over the long term. And to some extent, we're borrowing returns from the future. We have very high levels of valuation. Eventually, the market valuation is probably going to go back down to where it was before. And when it does, returns are going to be much less than that. But for right now, and we think for the balance of the year, things look to be pretty good. There's a lot of question about inflation. I can talk a long time about inflation, but I'm going to give the short version. And if you want to discuss that, I'm happy to do so. If you think about inflation theoretically, it really shouldn't happen in the sense that if markets are free, prices should adjust relatively quickly. They shouldn't just keep going up and up. Two things can change that. One, if the central government pumps too much money in, and the second is if there are bottlenecks. Now, a lot of people are worried because the central government's pumping a lot of money in. But in general, that money is going to people who are putting it into financial assets and not spending it. And what is happening to financial assets? They are getting inflated. Prices in the financial markets are very, very high right now. But there is not any shortage of goods, and it's shortages of goods that cause prices to go up. Now, why are we seeing shortages in certain places? Lumber prices went up, although they went back down. As one example, there was a chip shortage. Those are all bottlenecks. Bottlenecks don't last very long unless there's something artificial, like the oil price embargoes in the 1970s. And most observers believe that even though we have gotten a couple of bad inflation prints, that a combination of globalization, labor's lack of bargaining power, generational turnover, I mean, a lot of baby boomers are retiring, being replaced by cheaper workers, and shifts in who the money is going to. If money goes to less affluent people, they spend it. If money goes to more affluent people, they invest it. And right now, the money, is going more to more affluent people who are investing it and inflating asset prices, but not inflating everyday prices. So most people believe that big inflation prints, and there have been a couple of them, are temporary, and that inflation is not going to just keep going up the way it did in the 1970s. That is the consensus belief right now. Not everybody agrees, but that's kind of the consensus. So that's what we see going forward. I think, and we're well positioned. Our portfolio is, well positioned for for all of these things. But I just thought I would cover that. Any questions about the future? If not, Mr. Chairman, I am done.
Any questions from the committee or any questions from staff? Christine?
If there's not any questions, I did want to point out just a couple of things to the committee, Mr. Chair, on this report, if
Go
that
ahead.
would be okay with you. Both of the items I would like to point out are on page 10 of Barry's report. And on page 10, there's just a couple of things that I wanted to make the committee aware of. And one, this is a table on page 10 that shows you the classification of the assets within the closed pension fund. And so just to start with, as you can see, 96.5% of the assets, it says TCRS, and that's the large account that is invested, actively invested by TCRS full-time staff that Barry was talking about, his comments about what a great job they've been doing. That 96.5% is what is managed by that staff at TCRS, the Department of Treasury. The next items that begin with Hamilton Lane down to RMS Forest Fund, those are what are identified as non-conforming investments that were set up many years ago, before the plan was actually transitioned, where the assets were managed by TCRS. And while they are small percentages, they are now managed by TCRS staff. They are just not liquid. And so as we receive investment income off of these small categories, we reinvest that into the TCRS, the large fund. So that's why you're starting to see some small shifts, and we're at 96.5. The very last row, it says holding cash. I wanted to point out to you that I sent to the committee an update last month of some items related to pension, and one of my updates related to this specific row. And at the end of the calendar or fiscal year 2021, the Board of Mayor and Aldermen voted to make an additional $1 million contribution to the closed pension. And what we did with those funds that were appropriated by the board, we transferred $1 million into this row, into the cash account. And the reason why staff handled that additional $1 million was because we certainly we do know we have defined benefits that are irrevocable and they're due to retirees or active employees when they become retired. But we also have a certain group of employees who were hired before 2001 that have what's called cash balance accounts. And it's a certain group, and it's been closed for 20 years now, so we know who that group is. But what happens is when an employee retires in that cash balance program, they have a choice of either rolling that money out of the cash balance account, or they can annuitize it to help them have a little bit larger defined benefit. But we don't know until someone retires what they're going to do. So we actually, when we asked the board to put some additional money into the pension program, rolled that money into that account because we did look at who is eligible to retire in the next couple of years. Not everyone will retire. Not everyone will certainly choose to roll. But because that group has not changed in 20 years, those folks are getting close to retirement. So if everyone in the next couple of years retired that's eligible, and if they all rolled out, it's over $2 million. So that's why I wanted to point out to you that typically you see that cash more of $300,000 to $500,000, but we did direct those funds, and they are still part of the pension program, and they're still dedicated assets. But when someone walks into the HR department and signs up to retire and is given a choice, that starts the process of actually having those funds directed appropriately. So I wanted to point that out to you, that transfer did occur into an account that is primarily used for those cash balance rollouts that may happen at retirement.
So Christine, go back on the other allocations. I know from years back, TCRS now is making the decision if they fully liquidate, what it goes into, so we don't make that decision anymore. Or I think we said we were just
Well-
gonna wind them down eventually.
Well, what the board agreed to in the resolution to have the management handled by TCRS was that they would advise staff if they chose to liquidate one of these non-conforming assets. And that is something that they've not made a move to liquidate at a loss, but it's as we receive, sometimes it's very small returns, sometimes it's larger returns, or if they're selling part of the investment out, then we clear out part. And we've had at least one of these just sell out, that we just received the funds and we put it right into the TCRS account. So they are managing, but we receive the notices. In fact, I still receive all those notices just as their staff does. And if there was ever a recommendation to liquidate, we believe the spirit of that resolution is that they would contact us and discuss anything that would be a loss to the fund.
Okay.
Any other questions of either Barry or Christine?
Can I make one comment about me? Yes, you can hear me. I think I heard everything Christine said. If I'm repeating her, I apologize. Those are all closed-end funds, which means they terminate. They will all go away over time. And if we sell them now, we probably are going to lose a little bit of the write-up that they will get at the end when the final assets are disposed of. It's not, relatively speaking, a whole lot of money. So basically, if we just sit there and let them come to us, we tend to benefit, but they will all go away without us doing anything. They all have termination dates. They differ, depending on the fund. Some are soon, some are later.
Yes, that is correct. They all have sunset dates, but because of the management of those funds, there's at least one that chose to go ahead and end a little earlier. But we are managing those with working with TCRS.
Any additional questions or comments? If none, then let's go to item 5 on the agenda, which is the actuarial report for 12/31/2020. Kevin, you're up.
Does everyone have a copy of the presentation? If you don't, I've got some extras here. Well, my name is Kevin Sullivan, for those who may not remember, and my colleague behind me, Sylvan Limperville, we're the actuaries, our firm Finley, for the City of Franklin Employees Pension Plan. So kind of going through some of the information here, I want to first give you a little background on the plan and the active populations, an assumption update, some key results, key demographics of the plan, and some other issues, which one of the issues I wanted to cover relates to actually item 7, so we may hold that until we talk about that as item 7.
May I give those?
Sure. So first on slide 3, a little bit of background on the plan. When we think about the employees of the City of Franklin, there's really several different benefit structures here. Certainly for those hired after January 1, 2017, they are in the TCRS plan, so there's no liability in this valuation for those individuals. That's all with TCRS, and that benefit is funded through the contributions that the city makes to the TCRS plan. Within the main plan itself, what we call the closed plan, there's really 4 general tiers. Tier 4 is actually those hired after February 15, 2010, and they did not elect to contribute to the plan, so there's actually no liability in this plan for those individuals either. Their liability is in a defined contribution plan that's fully funded separately. But in general, so the other 3 tiers are the individuals who have liabilities in these plans, or in this plan. And that's providing a little more detail over on slide 4. I won't really spend any time on that. But moving over to slide 5, the assumption update. So every 5 years, we do a full review of the assumptions and update those assumptions. We did that in 2019 based on looking at data at the end of 2018. However, the discount rate, which is a key assumption, has been getting updated every year based on a pattern of reducing it 10 basis points. So we started at 7.5, and progressively dropping it by 10 basis points to 7.4, 7.3, 7.2. We're now at 7.1%, and that pattern continues until we get to 7.0% next year. Now, at that point, we may want to revisit that, just look and see what makes sense going forward on the discount rate. Certainly, discount rates across the country on public pension plans are coming down. Right now, the good news is I'd say you're a little below average, which is probably where you want to be on that. You want to be a little below average because if your discount rate's a little lower, your liability's a little higher, and you've already built in that those liabilities into the valuation itself. Something we'll talk about in a moment. TCRS is currently at 7.25, but they're looking at potentially lowering their rate. So that may be something, a reference point we want to keep an eye on, see what TCRS does with that. But that 10 basis point change in the liability or in the discount rate does cause an increase in the liability of about $1.9 million and an increase to the city's annual contribution of about $200,000. So that's the impact of lowering that rate. It makes the liability a little more. It makes the plan look a little more underfunded, or your unfunded liability a little larger, and so it increases your contribution slightly. So on slide 6, I know this is a question that you probably all often get or wonder to yourself, how well funded is the plan? Any public or private pension plan, that's always the question that's most often asked, is how well funded is the plan? And unfortunately, there can be several different answers for that. So I'm going to walk through kind of some key answers to that and maybe point you to the one I believe is the best measure of how well funded the plan is. First is a number that you'll actually see on a following slide, the present value of benefits. Now, on this basis, the plan is 79.1% funded. However, that's really not a good measure to say how well funded the plan is. And the reason is that present value of benefits includes all benefits that the current active population is expected to earn over their full career. So you could have someone in the plan who's 30 years old and we're expecting them to work another 30 years. All of those future benefits are in that number. And so it's not a good measure of how well funded the plan is right now, because you really shouldn't have the assets on hand right now to pay the benefits that that individual will earn over the next 30 years. What you do want to have on hand is the assets to cover the liabilities that that individual has already earned. And that's a better measure in the second number, what's called the entry age normal accrued liability. So this includes the liability of all the retirees, the full amount of their liability. That population we call the deferred vested, all of their liability. And for the active population, it includes all the liability they've earned to date. And it actually includes a little more because it includes the expected future compensation increases for those individuals that's going to affect the benefit that they've already earned. So on that basis, the plan is 82.8% funded. So we think this is probably the best measure. The last item is what's called the accumulated benefit obligation, and that's the liability if everyone who's an active member terminated right now. If they terminate right now, they're not getting those future compensation increases that could grow their past benefit. They may not become eligible for early retirement benefits or other things. So on that basis, the plan's actually just over 100% funded. But going back to that middle measure, the 82.8, one couple comments I'll make about this. It may be easy to get funded ratio envy if you're looking at a couple of large plans in the neighborhood here. TCRS and Metro Nashville are both 95+% funded. But a couple things to consider in that. First, TCRS is widely considered one of the best managed and funded state plans in the country. So that's a tough one to compete against. Similarly, Metro Nashville is regarded as one of the better funded municipal plans in the country. Largely across the country, many municipal plans are not in good shape and would love to be at 82.8% funded. So that is certainly nothing to be embarrassed or ashamed about. That's actually a very good funded measure. One other thing to consider when you're comparing yourself to maybe Metro or TCRS, both of those plans currently use 7.25% discount rate instead of 7.1. If the city of Franklin used 7.25, you'd be more like 85% funded. So that difference between you and maybe those that appear to be better funded, a little more narrow than these numbers might represent. And
so does our bond rating, that AAA status, does that come into this at all? That our wherewithal, if we couldn't meet, does that give us a extra bump up? Because Metro Nashville is not what we are, certainly in that status.
I can speak to the conversations with the bond rating agencies, and yes, really, every time that our rating is reviewed, we have a conversation about our pensions. and we do disclosures in the years that we don't have formal requests for them, and we do disclosures. I get questions on the pension, so it is something that pensions are a hot button topic for rating agencies. Has been for a good while, and certainly we actually do talk with them about the assumptions such as the discount rate, because they do get down to that. They want to make sure that our assumptions that they believe are reasonable, and so that is something that is very specific. And in fact, we just received a new rating on our water and sewer revenue bond here for the city, which we're proud of. That was just upgraded to a AA2, and we were asked questions about our closed and open pensions. So it's something that it's involved in any type of credit review that we have.
You know, I'll just provide a little more general answer from what we see across, other, the broader municipal plan space. Yes, how well-funded the pension plan is something that's considered by bond rating agencies, and they're looking at risk. So they're looking at things like the assumptions, specifically the discount rate. They're looking at whether you're using a market value of assets or a smoothing method that ignores gains and losses for a longer period, and you're using a market value, which is good. They're also looking at things like, is the plan still open to new participants or frozen? Certainly a frozen plan or a closed plan rather, has less risk than an open plan. So those are all things they look at, and certainly the pension plan's a big part of that and all those factors. So let's see, moving on to slide 7, some key results for funding, and I've shown the current year 2021 and 3 past years. First, on the participant population, you'll notice that the active population is continuing to decline because we've got a closed group. So the number's down about 28 individuals from January 1, 2020 to January 1, 2021. Correspondingly, the retired and disabled and the deferred vested populations are continuing to grow as folks move from the active population to those two populations. The annual covered payroll declined, which I think this is second year in a row there's been a decline, and that's just occurring as the population itself declines. However, the average annual earnings continues to grow a little bit, which would be expected. Those who remain are continuing to get pay increases that grow their earnings. The present value of benefits grew for the year, which also led to the unfunded supplemental liability, the unfunded liability of the plan growing. So your contribution each year consists of 2 components. It can consist of what we call the normal cost, which is the value of new benefits being earned by your active population. And then there's a second component to amortize this unfunded liability. So the unfunded liability grew, which generally is a bad thing, but the reason it grew is because we lowered the discount rate. Lowering the discount rate added $1.9 million to this number. So if we hadn't lowered the discount rate, the unfunded liability would have declined, which is what you want to see. The actuarial asset value, which for your plan is market value, this is the second year in a row we've seen a nice growth in that number to $136.8 million. The normal cost, which is again the value of the liabilities earned by, or value of benefits earned by your active population, actually declined again to $2.3 million, and that's just because the number of individuals in this group is shrinking, so the number is correspondingly shrinking. There's also expected employee contributions, which reduces that number. The recommended contribution, which is that normal cost plus the amortization of that unfunded liability, grew by about $100,000 to $5,160,000. But again, if it hadn't been for us lowering the discount rate, that number would have declined instead of increasing. It would have declined by about $100,000. So if we look at what we call the security ratio, which is the present value of accrued benefits versus the assets, that grew for the year up to 100.6% versus 105%. So that's certainly a good measure. And again, that's very much, it's the same as that accumulated benefit obligation, that if everyone had terminated, you have enough money to fund their benefits. And the answer to that is yes, you do. Okay, a little bit of history on slide 8 of the funded status, just for the last 5 years, including 2021, moving with the later years to the right. The liability is $165.2 million, the asset value $136.8. So that's the funded ratio we talked about earlier on. And again, this is how we measure for funding purposes 82.8%. And you see the progression of that discount rate declining from 7.5% in 2017 to 7.1% in 2021. And again, that will continue next year where we lower the discount rate to 7%, which was the goal when that was initially set. So some history on the contribution on slide 9 for the last 5 years. So 5.2 being the recommended cash contribution for 2021, up just slightly from the number in 2020, down from roughly $6 million in 2019, which 2019 was the year we incorporated new assumptions in, which did have the impact of raising the liability and raising the recommended contribution at that time. But certainly moving in the right direction since then, with contributions coming down slightly. On slide 10, this is a little bit of historical participant count information. With a closed group closing at 1,117, this is what we would expect to see, a slow progression of the population declining in the total stack. The blue, which represents the active population, declining much more rapidly. So over time, we're just going to continue to see this progression of active participants moving to deferred, vested, and retirees. The entire population declining very slowly. But certainly as we move from having fewer actives to more inactives, that reduces the risk to the plan, because a retiree or a deferred vested have less risk to the city, to the plan, than do active members, because active members, we don't know what future pay increases will be. We don't know when they're going to retire. We don't know the form of benefit they're going to take. Once all of those decisions are made for a retiree in particular, there's a lot less risk. The only risk from that point on is investment risk and mortality, which obviously we don't know when folks are going to pass. I'll see quickly on slide 11, the payroll history. The payroll did increase from 2017 through 2019, but now as we have a closed group and that group is shrinking, the total payroll is dropping. See quickly on slide 12, a little bit of gain loss summary for 2020. In total, the gains and losses were a gain of about $200,000, which is good. Gains and losses tend to offset over time, and you can look through this and see we've got some fairly large numbers for gains and losses, but they're largely offsetting. The big gain was investment gain for the year of nearly $6 million versus expected, which as Barry talked about, the good investment results certainly for last year is what drives that number. The retirement decrement and termination decrement were losses, which largely was due to folks retiring or terminating differently than expected. The other items are largely small, although retiree mortality, which is something leading up to the next experience study in a couple years, we always keep an eye on. This indicates a gain, which means folks dying faster than expected. There's entirely possible some element of COVID in that, and that's something that we're looking at not just with the City of Franklin, but across the entire economy. How much of an impact does unexpected mortality due to COVID have on pension plans? See, the last item I have on slide 13, well, actually, there's two items here. One I'll cover. The second one I may hold off on until we get to item 7. The discount rate maximum. So under state law, the discount rate must be no more than 50 basis points above the rate used by TCRS. So right now, TCRS uses 7.25, which means 7.75% maximum. You're well below that. No concerns there. TCRS is looking at changing to as low as 6.75, which would mean a maximum of 7.25. So even if they make that change, you're still in good place there. No concerns. But that's certainly something we'll continue to keep an eye on. Just based on how future expectations of return changes, there's a possibility they could change that a little more rapidly. So that's certainly something we'll continue to keep an eye on. So I know I went through that kind of quickly. Any questions or comments?
Let me ask you a question. Help me crosswalk what you just talked through with this chart that's in this report every quarter that shows sort of our history versus a 7.1% investment target. And it shows us above that. So I've always tried to connect that with some of these other things we talk about.
Oh.
That's page 7.
Okay, good. So you can get it quicker.
Because I've always understood this to track whatever our investment target is over time and where we are now. And sometimes we're above it, sometimes we're below it, more often below it. This time we're above it collectively.
Mm-hmm.
How does that fit with what you just shared with us?
Let's see if I'm trying to make sure I understand what he has here.
Maybe Barry can
Yeah,
chime
this-
in on that too. I'm just,
Based on what I'm seeing here with a 0% return reflected, this almost looks like a historical progression from 2008 of
Yeah.
if we had always hit 7% versus our actual return, and then the last showing 0% return. So I think what this would mean is that because your actual returns are above the 7.1% hypothetical return, cumulatively since 2007, your returns have averaged more than 7.1%. Which is very much what I would expect. Looking at other, large diversified pension trust funds, they've been between 7.5% over the last, well, this is a little less than 20-year period, but 20-year period tends to be maybe a little higher than that. But he's not counting some earlier years that were actually pretty good, and he's picking it up with the bad years in 2008, 2009. So I think this just means that historically, since 2008, you've beat 7.1%.
because we've always had this chart, and it hasn't always started at 08. That's kind of what I'm curious about. And maybe that, again, is more of a Barry question, because I've always thought it tracked it from, the history of our fund, or a longer period of time than just 08, because I believe we've always had this sort of same outlook here. So I'm just trying to connect the two, and
Yeah,
maybe they're a little different purposes. I'm not sure.
That's entirely possible. I may reach out to Barry and just kind of get a better understanding of what's here and reconcile that with my information. It does almost look like certainly the actual return is ending with the actual trust balance, it looks like, of about 136. And the fact that last year you were a little below and then you beat the 7.1% this year would put you a little above. But I can reach out to him and get a better understanding of what's here and then reconcile that with
Well,
our
we're
information.
starting in a hole. I mean, 08, 09, 10, those were all horrible market years. So if we're starting in a
Correct.
hole and trying to dig out, I think, Eric, I guess what you're saying, we finally dug out, 12 years, whatever it is, 12 years later, and above the actual bogey of the 7.1. The only other time was in into 2013, 2014.
Is there significant funding?
So I guess my question is, if we go back to the discount rate, since TCRS is lowering theirs to 6.75, we didn't bogey our 7.1 against what they did. That was just our decision to start lowering that because of return expectations, correct?
It was, and I recall that deliberation was that there was a desire to step down in a slow, measured fashion, and that certainly TCRS, as Kevin was describing, they have started at such a position of almost fully funded, and the sensitivity of changing that discount rate by 25 or even 50 basis points at one time,
Yeah.
for them would not look as it would still be dramatic, but it wouldn't look as dramatic as a plan that is still well funded, but is at a different place, and we went ahead and discussed moving to a lower rate in a measured way of 10 basis points a year because of the impact. So, I think we're getting ready we're going to be at 7% this next year, and that was the goal all along, was to pull it down along with certainly, as you're talking about, the experience of several years ago, and the pressures of all of the evaluators all of the either investors and different people who review us. There was a pressure just nationwide to reduce those discount rates and not show pensions that may be fully funded simply on paper, but not truly be fully funded because those investment returns were not reasonable. So we went ahead and started that progression, and certainly there's accounting rules that have changed in recent years regarding pension disclosures, and there's one in particular, GASB Statement 87, related to pensions, and we, following those reporting requirements, we have to show a sensitivity on discount rates that's even greater than what we would typically every step, show 1%, not just 10 basis points or even 25 basis point, but the whole 1%. So that's something that is pretty shocking when you see just a 1% change, sensitivity on discount rates, what it does to the ratios of the plans,
Right.
which may or may not really be relative to what they can earn. So
Right, because when we say, the plan's 82% funded, 82.8% funded at 7.1, that implicitly assumes that we earn 7.1% from here on out. If we don't, then your contributions are going to progressively rise to fill up that gap. If you do better than 7.1, it's gonna drop to maintain that gap. But it's all based on actually hitting that return.
and since we certainly have we do fully fund our annual contribution as required and as calculated by the actuary, that's something that it's very meaningful from a budget perspective to understand what the implication of changing that discount rate is, and that's why we ask the actuary to report to you, and then I'll give I'll give my own report to our Budget and Finance Committee, and that's about $200,000. Between the 19 and 20 was the change in that 10 basis point decrease in the discount rate.
And as Christine alluded to, if we go back probably 5, 6, 7 years, the average discount rate in the country for municipal pension plans was 7.5% or a little better. Now it's about 7.25. So all public pension plans are reducing their discount rate. And that's true even if they're not really changing their underlying investment allocation or philosophy. It's really just a recognition of future returns may not be as good as we had previously believed.
Any additional questions from staff? Any additional questions from the board members? I think that was an excellent explanation as why we lowered from 7.5 to 7, well, hopefully getting to 7.0. I would say this, I think we anticipated the state dropping theirs. And that was the reason that we went with what we went with, was that 10 basis points was because we anticipated the state dropping theirs, even though we have dropped ours a little faster than they have dropped theirs at 7.25 then. No other questions? Let's go to, well, I've kind of laid here we go. Let's go to item 6 then. It's a report of July COLA. Christine, you're up.
I just wanted to update the committee, as I reported last month in your written update, that the calculation for the cost of living increase for the retirees in the closed pension plan, which is where all of our retirees are at the moment, was 1.65%, and that was approved. It's a calculation based on the change in the March Consumer Price Index, and we present that to the Board of Mayor and Aldermen every late spring once that number is announced. We did implement that with with that cost of living increase of 1.65% with the retirees' July payment. Certainly I did want to just make a quick commentary that certainly that probably doesn't feel as what the experience is for how much the world is, how much just our daily lives are costing these days, and that's something that we can acknowledge that is certainly the fact. The calculation is a point in time, and I'd point out that actually TCRS uses the month of April. We use March, but TCRS uses April, and the point in time comparison, certainly with most everything that we're doing in comparing to prior years and what we do here at the city, 2020 was just out of whack. All the monthly indicators were just very different, whether it be sales tax and in this case CPI. But the April change was a 1.4%. So if you have friends or family who are retirees from the state or a school district or another city or county that's in TCRS, that was a 1.4% increase with the end of July payments. So it's something that we'll be certainly looking at, next year, a change in March compared to March of 2021. But that I wanted to report that cost of living was put into effect with the July payments.
Any questions on COLA? Let's go to item 7, Tennessee State Chapter 382, employee request for pension transfer to TCRS. Eric, I think you want to make a comment or two at the beginning.
Sure, yeah. This will be kind of a team effort between myself, Christine, Kevin and Frank, and whoever else, some of our HR team too. But we want to walk through this with you, explain what we know about it and how it relates to our existing closed pension plan. And if this committee is comfortable, we'd like to have you weigh in on a specific recommendation to our board for discussion purposes at this point. So, and as part of the last completed legislative session earlier this year, there was some legislation passed that relates to the ability to allow members to transfer in employee contributions into TCRS for credit, service credit, essentially. There's not a ton of specifics on how that works. What we've been able to flush out talking to TCRS folks and looking at some of the forms they've developed is essentially it's a math calculation about the dollars that employee may have put in or that may have been put in on their behalf, and then doing a conversion calculation of that into specific years of service. It's not a year for year. So if you had 10 years in some pension system and you'd say, okay, I'd like to convert that into additional TCRS time credit, service credit, there'd be some calculation of what that dollar amount is, and that would translate into whatever TCRS's calculation is that's worth 2 years, let's say, or whatever it might be. So that would be what they'd be able to get credit for. It's not a year for year. The other elements to that is just looking at the specifics of our situation. We've been advised by TCRS officials that they don't see this as applying to our specific closed program, pension program. We would also state and advise a great deal of caution towards pulling any resources out of a closed pension plan, because we're kind of all locked in with that together. The vast majority of folks who might have been in the city's program that might now be asking about this, and we've had 2 folks ask us specifically, probably didn't pay in any employee contribution. If you look at that over time, the vast majority of our folks that are eligible did not pay in. That pay-in didn't start until 2010, and then we had that window between 2010 and the end of 2016 where we had a 5% contribution for those new employees, and then from that point forward, those folks have been part of the city TCRS program. So it's very difficult to even gauge what that contribution would be and what that math might turn out to be. And so with all those reasons, we're very strongly advising that and the existing plan, the way it's written, does not provide for this. So you would need to go and amend the plan, provide for it. We'd have to somehow figure out how to calculate it, which honestly, I don't think we could even give you any sense how to do that. And so it's got lots of complexity to it, lots of difficulty to it. And honestly, it's a very difficult path to go down where you'd start pulling assets and membership out of a closed plan. I just think that you set yourself up for a real problem, and especially when we're advised that this doesn't necessarily even apply to us, that we ought to keep it that way. It's much better for the integrity of the plan and the whole that we do it that way, and we've got this nice clean break between the closed plan that we have now and the existing TCRS, and I would advise you strongly to stay there. But we're glad to answer any questions you have about it, and I gave you kind of a broad overview of the issues. The folks down at the table here have a lot more detail with it, and I'll open it up for them to fill in any blanks that I didn't touch on, but that's the general sense of what we'd like to talk through with you this afternoon. So.
Yeah, I'll make a couple of quick comments, and one, in my presentation, I think I showed a picture. That's actually the entire bill, that one page. It's not even a full page, and this is so certainly the bill lays out a general concept. It does not give details. And the details are what we really have to know how to do here, because there's really two sets of complicated calculations. The law or the bill says employee and employer contributions. Employee contributions, we understand what that means. Employer, that's not defined. Because when the city of Franklin makes a contribution to the pension plan, it's not allocated by person. There's parts of it where we could come up with a calculation by person, but there's a piece of that contribution that's part of amortizing unfunded liability, and that's related to people who may have retired 20 years ago. So it's not at all clear what employer contributions would mean for the city of Franklin plan. And then on the other end, when you actually have a dollar amount, what that translates into, as Eric alluded to, for that participant is not clear at all. The participant may go through this process and realize they don't like how it translates because they think it's it's not as good a deal as just leaving it in the plan originally. So there's a lot of unanswered questions here from the calculation standpoint of how this would work. And that's why, our thought was there may be others out there other entities who go through this process and kind of figure out all the details. And it may be those that this law was actually geared towards when it was written. But it might make sense because I think the indication we've got from the state is this doesn't require the City of Franklin plan to do anything. It doesn't require any plan to do anything. It's all voluntary. So until all those issues are resolved, it makes sense to maybe sit tight.
Any comment, Frank?
I would agree wholeheartedly, because when this thing came out, just to even start trying to calculate this thing or even start to figure out how it works. Now, I will say, just to clarify, it was for an employee who worked at a municipal plan who then goes to the state and becomes a state employee. So the idea was they would take that municipal time and be able to buy time in the state plan. But the plans are not equivalent. The benefits are not equivalent. So that's one of the problems you have. Where it might, I was trying to think of where this might come up, and TCRS doesn't control what we do. We don't control what TCRS does. So trying to solve this thing, you've got two entirely different parties also. If someone has a cash balance account, they can make a lump sum election, and they can roll that over. So theoretically, I don't know what TCRS would do. They're not getting employer money, and the statute does say they have to get employee money. But theoretically, an employee could roll over to the TCRS plan, and if they let him or she or her, that employee could purchase whatever credit that buys. But the statute's absolutely clear that TCRS is not going to pick up any additional liability based on this transfer. So TCRS is going to calculate this dollar buys this benefit in our system, and that's all you get. So you might have 10 years here, and you might get 8 years over there. It's just, that's a calculation. But TCRS has said, although the statute didn't make it clear, but I'm glad they've made it clear thus far that they cannot demand that whether it's a closed plan or an open plan, they can't demand that your plan make a change. So, you would have to amend the plan to provide for that transfer, which it does not. And, but they are not taking the position that this mandates that any municipality or county make this change. So I'll be curious to see if anybody does make such a change because of the difficulties of it. And from my side, you accrue a benefit in this plan based on this plan's formula. And so if all that money goes to TCRS, I don't know what you do with this leftover accrued benefit. You no longer have any, I guess you could refund it, recalculate it, but then that would make no sense. So I agree. This would be tough to try to even figure out if you wanted to. Now your employees, or those few employees who've gone over, may want it, but you have to address that with them. That's an employee question. And if they understood what benefit, because your benefit formula is greater than the TCRS benefit formula, so they probably, if they saw the calculations, wouldn't want to do it because they'd be buying into probably a smaller benefit than they would get if they took this benefit and that benefit whenever they get the two of them.
Yeah, I'll kind of continue that thought. There's a lot of complexity here, and unfortunately, I think a lot of it's going to actually fall on the participant themselves trying to navigate this because, to Frank's point, if it's communicated to the participant as years of service being translated, they may think that 6 years of service with one entity translates to 7 years with TCRS, but it may actually be a smaller benefit because it's a smaller benefit multiplier. So there's a lot of room for confusion. Also, one other comment on it does have to be, I think the term they use is without creating any new unfunded liability for TCRS. That gets tricky because what the unfunded liability is with TCRS using 7.25% discount rate right now changes when they go to 6.75%. So this is just going to be very complicated for the participants themselves.
What if it enables them to retire sooner in the TCRS system? How does that not potentially create a burden on the TCRS system? I mean, I think that's again, kind of unknowable.
That's
really.
a great point because it's the idea of not creating any unfunded liability, that's all based on assumptions. So if a participant, that's a really good example, actually, participant moves over and then that maybe allows them to take advantage of even though it may be a worse benefit, it's a better early retirement benefit, and so therefore they could win, or they could lose too. And that's, again, all that's on the participant, which is, it's a very tough decision for them to make without perfect information.
Yeah, my first concern was how in the world to communicate this to the participant. Of course, TCRS has a burden to communicate, but you would have a burden to communicate too, because the participant has to make an informed decision. And if we can't figure it out,
Yeah.
I don't know how a participant's going to do that.
So I think the bottom line is, given what we know and don't know about this, it would not make sense. We would not advise making any changes at this point. Hold where we are. If we get questions from former employees about it, the plan as written does not provide for it. What our plan is at this point is to get feedback from you and then maybe have a work session discussion with the board just so that they're informed and they can understand where this puts us and why that answer is what it is at this stage. Just to make sure, because they may get questions and we'd like to just be as open as we can about why it is what it is right now. So, and Kevin Townsell gets to answer those questions sometimes too, as the program, the plan administrator. So we want to make sure he's got guidance that's consistent across the board too, and that somebody doesn't hear something from him and then ask their alderman or the mayor and they are not on the same page. So that's our goal today. And I don't know, Christine, you want to add anything to that?
Well, I did want to give some commentary or some background from an accounting perspective regarding pension trust funds, because it's really important. Certainly we as your staff, we manage all of our funds with, they're all public funds, and we take great cares to follow all of the rules required. But certainly, as we classify all the different funds that the city maintains, there's a three-pronged test for what's called fiduciary funds. And I just wanted to just bring up again, because I think it speaks a little bit to the philosophy of what this law would ask of a government who is a single employer, who holds a single employer pension plan, because the three-pronged test to define a fiduciary fund, which puts even greater responsibility on us as the city and our governing body that is responsible, is that if you meet all three of these, you're a fiduciary fund. First of all, that the benefit plans are irrevocable, and these are irrevocable benefits. Secondly, that the plan assets may only be used to provide pension benefits. That's the only thing that is paid out of this fund, is providing pension benefits. But thirdly, and I think this is something that's really, it speaks to me when I consider fiduciary funds. These assets are legally protected from creditors of the employer. So we don't want this to ever happen, but if we get behind on our bills to anybody, they cannot come after. A creditor cannot, the city of Franklin cannot come after this fund. Those benefits are devoted to the current retirees and then the future retirees. And setting a precedent of transferring assets, although it would be well-meaning, and it seems it may seem harsh to say because these were people who were part of our team at one time, and we know that they performed an admirable service, but transferring assets out of that closed pension doesn't necessarily fit the three prongs of a fiduciary fund, and because that's not that's actually releasing assets that we're entrusted to hold for the beneficiaries of that fund. So that's not exactly addressing the Chapter 382, but that's something that when as we manage both our single employer and our multiple employer plan with TCRS, that we take great care in managing pension funds, and it's a high standard. So I just would my agreement, certainly I've had a chance to speak with Eric, our city administrator, and our city attorney, and our professionals, but setting a precedent of transferring assets out of a closed pension plan would concern me. So, but you've heard a lot of us talk about it, but certainly if Chairman Barnhill is open to taking either comments or questions, we would like to know what, in first blush, if you have any thoughts.
Any questions or comments from anyone on the committee concerning the new state regulation? Anyone want to question Eric's recommendation that we slightly ignore?
Certainly don't act.
For the time being.
Is that a motion that we ignore it for a period of time? Is there a way?
Do you need a motion on this?
I mean, I'd like a sense of the committee, because I'd like to reflect that to the board, because they're going to say, well, what's the pension committee think?
Okay.
And two of you have double duty, but the rest of you don't. And so I want to make sure that the way we're addressing it and approaching it seems fair to the folks that we're representing here. And I think it is. I think it's the right thing to do.
Well,
but I
I
want to
mean-
make sure that you all are comfortable with that being.
Well, I'm a banker, so we don't release collateral. So I would say,
That's totally against everything you've ever been taught, right?
as Christine's talking, I'm like, absolutely, she's 100% right.
Yeah.
Yeah.
Well, I'll entertain a motion to that effect then.
Mr. Chairman, quick comment. I thought that what I heard Eric say was to have a discussion later on to kind of lay out and explain what it meant, not ignore it, but to make sure more information was presented to be intelligent as you move down the line. When I first read it, I thought that the intent was if there's an employee who may work for municipal government and he or she gets a job with the state to kind of help bridge a moment, but I thought you did an excellent job of explaining the fiduciary aspect of it, which I think will be helpful for any person speaking about it.
Eric, was that your intent? Because that wasn't exactly what I heard. I heard that the enormous issues involved in changing the plan and the uncertainty as to where we were going with that was such that it wasn't your recommendation or at this particular time to get into the changing of the plan. Is that
My recommendation for action is that you take no action.
right?
Meaning, don't change your plan. The plan as written and the interpretation we have of the law that was passed does not require us to do anything and does not mean that we need to make any adjustments in the plan as written. And that given the fiduciary responsibilities, given the uncertainty around some of this as well, that it would not make sense to make any adjustments in our plan with what we know at this point. Now, maybe there'll be something else that comes down the line that explains this in more detail and gives us a more refined understanding and how it might apply to any one of the 3 or 4 groups of pension folks that we talked about in the earlier presentation. You know, I'm not going to close that off. I doubt that will really change, but given what we know now, to kind of hold the ground in terms of what the plan says now, which does not provide for it, and the law does not require us to do it. So I would say don't do it and don't make a change given what we know right now and the responsibilities we have for the fund.
Well, let's put that in a motion then, and I'll put the pressure on the mayor to make that motion. If he's so inclined
The
to do so,
tables
he
have
may
turned.
disagree, he may disagree with our analysis so far on that.
Well, I certainly appreciate Christine's explanation, and Kevin's explanation, and appreciate that. And it's always scary when the General Assembly goes into session and some of the things that they come out with, and sometimes there are very special situations where they focus. So I will make that motion.
Okay. I'll second that motion. Let's vote on that motion. I won't even do a vote. I won't even do a roll call vote on it. Do you need the roll call vote? Well, let's do a roll call vote then.
What is the motion?
Yeah.
Just,
To stay status quo.
okay. Let's make sure. I
Make no
understand.
adjustment in your plan. Right now, folks are not eligible,
Right.
as the plan is written, to make any conversion of time into TCRS.
That's what I just want
Yeah.
to make sure.
No, that's good. Make sure you got it on
wanna make
the
sure
same
we're-
page.
Yeah.
Are you ready? Mr. Moore, how do you vote?
Yes.
Chris Bull, how do you vote?
Yes.
Kevin, how do you vote?
Yes.
How do you vote?
Yes.
And who did I miss on this? Mr. McGee, how do you vote?
Yes.
And the chair votes for yes. So that passes 6-0. The mayor doesn't get too many of those. You remember that one.
Yeah.
He didn't get too many 6 and 0s now. So we're fortunate on that, Mayor. We got that. Any other questions or comments to come before the committee?
I've got a quick comment. As I look over the agenda today, I noticed that there are 6 people involved in this meeting whose name begins with Ken, and I would like for people to start considering changing their first name to coincide with the majority of the committee.
Well, we can refer to them as with their last name, then how's that? Yeah. If we have nothing else and no other items to come before the committee, I'll entertain a motion to adjourn. Yes, a date and a
Chair,
time.
I have a suggestion for a date, but I don't know what the reaction of the committee would be. Looking for a late November date that we could incorporate third quarter results. We do have a Board of Mayor and Alderman meeting the week of Thanksgiving this year, which that would be the 23rd. I don't know if folks are in town on the 22nd, the Monday of Thanksgiving week. If that, anyone knows if they're traveling that week or?
I will probably be out of state
Okay.
during that. I don't know for sure, but
Would,
anticipate being out of state.
would the week, would December, we do have one BOMA meeting scheduled for December 14th. Would the day before, December 13th, Monday, December 13th, be another option? If folks,
Going down the line, December the 13th works for me, or I would think even the November date, but if you're gonna be out of town, let's look at December the 13th.
Even if I'm out of state, I could get on via virtual from, it would.
well, I believe our
if-
recorder.
If
You
that
can
was
attend, but you
if that
can't
was
vote,
possible.
right?
Sorry.
Yeah, you could.
I retract my previous statement.
But if December 13th, Monday, December 13th would work, we could do 1 PM. And I'll send out a reminder.
Does that work for everyone?
And hopefully, we should have a new member, I believe, by
So
by
December the
as well.
13th, 1 PM. All right, let's go to the mayor's favorite item on the agenda, and that's adjournment.
I move with great enthusiasm that we adjourn.
I second. All in favor indicate by saying aye. Aye. Any opposed? We are adjourned.